as we've covered in other videos, the buy is the most important aspect of everything that you do. If you buy a facility in a terrible market, then it doesn't matter how good you are operationally, it becomes very difficult to make it profitable. So all of your value creation really is made in the decision as to which facility that you buy, because you're buying a good facility in a good market with value add, then your business plan after that, your operations become a lot easier. If you buy an old facility in a market with low rents, you could be the best operator in the universe and you're still going to struggle to make money with that particular investment. Okay, so what makes a self-storage facility successful? The market, right? The market that it's in, the local market. And as we said, it's very localized. Between 1, 3 and 5 miles, customers are driving 10-20 minutes maximum. It's extremely localized as to where a good facility and a good market is. So the town next door might be a great market and this market might be terrible, or vice versa. It's that local with storage. So even though something's just 30-40 minutes away, it doesn't mean that the same economics apply to the market that we're looking at. So the market is extremely important, and we cover that in different sections of this course. And as we said, location and visibility then is a go or no-go factor in that too, because if you've got everything right, but then your property is difficult to get to and not visible, then getting traffic is going to be extremely difficult, especially if it's an expansion or new build. We talked about the demographics of the population, that it's growing, that we have a decent number of people there as well. We talked about the demand and supply and the rents, that we want a good number of low competition, in the sense that less than 8 square feet per capita of competition, and we want solid rents of at least $10 to $12 per square foot on average. And the thing to remember when you're looking at rents is that a 10 by 10, let's say it rents for $100, right? So that's $100 per 100 foot, or $1 per foot per month, right? But a 10 by 20 might go for $180. It's a bit less per square foot, and smaller units tend to be a bit more per square foot. So when we're looking at the average rents for the market, we do need to factor in the fact that smaller units rent for more, bigger units rent for less on average per square foot. So we're trying to get to, for example, maybe we use the 10 by 10 and 10 by 20 as the benchmark and average for those, because the bigger units, the 10 by 30s, 10 by 40s, might be only generating 70 cents per square foot per month, whereas the smaller unit might be getting $2 per square foot per month. So it's important to factor in which units which unit sizes you're using when working out the average rents of a market as well. And then the final thing is the asset itself, right? So we've done all of this work on everything else. If the asset's too old, then we don't want that, or the characteristics of the asset, something about it, such as terrible access or too small, for example, then that also kills the deal. So it's a really top-down approach. Many real estate investors look at the asset and then they look at the market and then etc. But really, you want to start looking from the top down. Is this a good place to own facilities? Then you can contact every single asset in that market to see if they'll sell to you, right? Because you found a great market, you know that all of the facilities in there are potential. If you start with the asset, then look at the market and focus too much on that particular asset, it might not be the best deal. So we want to look at great markets, then find deals within those great markets. So what's our acquisition criteria? So you need to set your budget really, and basically on your resources as to what you can do. Of course, you can get creative with financing. You can ask the seller to finance the property. You can raise capital. You can go to family and friends. You can go to a private investor partner and get them to put up most of the cash for, excuse me, 30-40% of the. You can get somebody to put up the cash for most of the equity, and you do the sweat equity of managing the property as well. So your budget isn't necessarily set in stone. You might have 200-300 grand in the bank, you might have 3 million in the bank. That's your first step. You need to know whether you think that you can raise the additional amount that you're going to need, and also if you're closing on a deal, the time frame to get that capital is relatively small. You need to bear that in mind. So you then want to be looking in your your selected markets. So as we said before, you want to really focus somewhere where you can get to the facility relatively easy in the beginning. It's great if you can visit the facility and the competition easily from where you are without having to fly and book hotels every time, because you're going to get a lot more insights, you understand the market better, and you can resolve any issues very quickly if it's nearby to you. So Next, we want minimum gross rents of $25,000 or higher, ideally 30,000 plus per month, because if your revenue and size is too small, you simply don't have the cash to cover the expenses there either. 20,000 square foot plus facility if there's expansion land. Why? Because you can run that facility, you can then expand and build to bring it up to 30, 40, 50,000 square feet and make it into a much better overall investment for yourself. And if that expansion isn't there, then really you need a larger facility out the door of say 40, 50,000 square feet units. How many units? Okay, so I mean the larger facility is usually going to have more units. So if it's about 50,000 square feet, you can expect around 500 units plus or minus, depends on the unit mix. So again, we're looking at a minimum of 200 plus units if it's a 20,000 square foot facility with expansion land. But really, you want a unit mix that favors small, medium units rather than all large, simply because those larger units are just a little bit trickier to rent out and they generate less dollars per square foot in general. The next thing we're looking for is built after 1980, because this means our repairs and maintenance are going to be minimal. If it's a much older product, you know, all your cash that comes in is basically going to be going out. And then you need to consider single story drive up or multi-story. Multi-story tends to be in markets where there's much higher populations, therefore much higher land costs, higher rents also potentially, and so it's a much bigger investment up front, which is more risk if you're new, but maybe it's also lower yield too, because if you're paying more up front, lower cap rates, it's a higher quality asset, then your upsides are much likely to be much lower. So we tend to focus on single story drive up or conversions or expansions or developments, as opposed to buying these large REIT style investments. The REITs have so much capital at a low price and cost of capital, they can afford to buy these multi-story units, right? It makes sense for them to add that to their asset column. Whereas for you as a private investor, you have more limited capital, you have a higher cost of capital, your time is much more valuable for you personally, so you want deals where you have that upside. The other thing we're looking at is the 10,000 plus traffic count, right? So we want at least 10,000 vehicles a day passing our location, our facility, with road frontage and easy access to. Ideally, we want this to be about 20,000 plus. Of course, if you're in a bigger market, then automatically these numbers are going to get bigger as well. But we do really need to look carefully at the road access, the road frontage, the visibility. These can really make or break your deal. The other thing we're looking at is the square footage, the rent per square footage per annum, which we look for $10 to $12 plus, because then that supports a higher level of revenue. It supports the expenses that we need to pay. There's more likely that we can drive profit margins and increase returns too. Ideally, you want some sort of retailer that brings additional traffic too. So if you're in a more suburban market and the population's low, but you're right next door to a Walmart that has 500,000 vehicles go there every month, for example, then all of those people are potentially your customers too. So population can be offset by some special factor, like having a Dollar General or Walmart nearby, some sort of anchor retailer that brings traffic to your door. Then you can look at a larger area when selecting where your property should be. Okay, so not only do we want, all of these tick boxes to be okay for the facility, how do we actually add money into our pockets, through doing this deal? If there's no way to value add to the properties, there's no operational efficiencies, even if you buy at a great price and get a good deal, you're not going to make much upside, because there's nothing you can do to drive the value of the property. So in addition to finding the perfect property on paper, we also want some opportunities or problems or something wrong with the property, in the sense that the previous manager hasn't done their job to the best, to absolute optimum, right? So that there's room for us to make some additional capital on this. One of the easiest is, of course, rents. If the rents now are below market, increasing the rents to market instantly increases your income, instantly increases your NOI, which instantly increases the value of your property as well. What affects profit? Of course, the higher your expenses are, the lower your profit's going to be. So maybe there's costs in the expenses that you can reduce. Maybe there's 2 on-site managers. You can get away with 1 part-time one, the rest done remotely, for example. All of these things can reduce costs and therefore increase your profits and profit margins. There may be the ability to expand nearby on the land next to the property. If you can expand, it's probably the highest ROI you can get in self-storage, because you've got the existing facility, the land is free in effect, free for you, you're building at the lowest possible cost, you've got brand new product, you've already got the cash flow and traffic from your existing facility, and you can send it there. So that's another great value add strategy that we want available to us. The other one is maybe the marketing is terrible for the existing facility. Maybe you've tried doing test calls to their customer service. You've called 3, 4, 5 times, nobody's answered the phone. So maybe they're missing out. Maybe their occupancy is much lower than it should be if they just answered the phone. The other is they may not be running Google ads. They may not have a Google My Business page. All of these things are things you can do to drive additional traffic. And as you get better at storage, you'll know if the property is missing out. If there's high demand in an area, high rents, high occupancy, but for some reason this property is lagging, maybe it's the marketing efforts. Maybe they haven't switched on any ads whatsoever. And you can find that out by asking the seller if they're willing to talk about selling the property. What advertising, what marketing have you been doing? And you may find that they've been doing very little, which gives you additional upside for your deal. As we said before, 85% of self-storage facilities are owned by mom and pops, right? Some of these people may have owned a facility 20, 30 years. The first 1 or 2 years, they've really, really looked after it. They really put their heart into it, and they were on top of everything, the accounting. But year 4, year 5, year 6, they're on holiday now and then. They're not really focused on operations so much. It's kind of coasting. So there's a lot of facilities out there with really, really great opportunities for you to come in with fresh management, revamp operations, lower costs, boost revenues. And so what we do is we try to focus on these off-market properties where there is mismanagement. Usually when it's going to market through a broker, the broker is going to work with the self-storage seller to optimize everything so that when they're selling, they're getting the best possible price. Of course, they may not have time to have implemented everything, but usually if it's on market, then it's much less likely that it's got some value add strategies, because now it's publicly known that this is for sale. There's many eyes looking at it, and there's not going to be that much of an opportunity there. There still may be, there's some great on-market deals, but we tend to look for off-market deals because a lot of these value-add strategies are then available to us. Someone's owned a property for 10 years, they're willing to entertain an offer, they see the offer, it seems fair to them, and the way they value their property is just based on what they think it's worth versus what they paid 10 years ago. But we see it, and there's all these operational efficiencies that we can enact that are going to drive revenue for us. So for example, let's say we were able to increase rents over the course of a year by $100,000 and decrease the expenses by $100,000. So we've got a $200,000 extra profit. What does that mean? At a 6% cap rate, that's 3.2 million in value add to the property. So if we bought the property at 3 million, we were able to increase income for 100,000 a year, reduce expenses 100,000 a year. We've just added 3.2 million in value on top of it, which is a fantastic return on investment. So small changes can make a huge difference because cap rates successfully multiply. So if you're using a 6-7 cap, you're looking at $15 back in value for every dollar saved or every dollar in extra revenue that you create, 15 times. So that's why operational efficiencies, value add can really impact your return on investment. The other best way is, of course, expansion and development. If we add an additional 30,000 square feet, for example, we're getting $12 a year per square foot. So that's $360,000 extra a year in revenue. Again, like I said before, we're using the cap rate. If we take out the expenses as about a third, then we're value adding $4.2 million to the facility by adding this 30,000 square foot once it's fully leased up and stabilized. And usually that land is free and it's financed by the existing property too, which is why it's such a great ROI. So you buy a facility, $5 million, it's got a decent healthy income, it's got some expansion land, you spend the money to build the 30,000 square foot, you get that additional income, and now your facility is now worth 9.2, 9.5, $10 million, because you're now gone from maybe say 50,000 square feet to 80,000 square feet at these market rents, and you've got a much better, higher value asset. So when we're looking at the facilities and the properties that we want to buy, the first consideration is all the checkbox of the market, the competition, etc. But really, as investors, what we're looking at is, okay, so how can I increase the returns of my investment? What are the value add strategies we can apply here? Are there ways I can increase the income? Are there ways I can cut the costs? Is there some room for expansion or development? You know, how do we drive additional profits to the bottom line to increase the NOI and get a better return for our investment? If a deal doesn't have that, then I think it's better to pass, even if it looks good overall, because how are you going to generate an extra $1 million or $2 million in value if there's not much you can do to the deal to force that appreciation? So look for deals where there is something wrong with it, in the sense that from the seller's perspective they haven't managed it properly, but from your perspective you can value add and capture that value back.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.